It depends. It's our Economist edition here in March. So predominantly, we're going to chat a little bit about how the weakening of the economic market or the markets are doing. As well, we're going to talk about how that's relating to mortgage rates. So if you recall from our forecast edition there in late January, we talked about things that may impact our economy. And this is actually still from the forecast edition there. Talked about oil prices and investments. So that is obviously something that's hit us really hard here in the last couple of weeks. We saw that oil today was under $30 a barrel. We saw it creep back up, so it's hovering there. And as well, what else is going on with COVID-19? There's no question that is definitely the black swan. So we know that that's going to further shut down the economy here for the next couple of weeks. We saw today or yesterday the government of Alberta announcing that the schools and daycares are going to be shut down. I just saw on the news that coffee shops are starting to stop the patron sit downs tomorrow, or as of tomorrow. So that's going to take effect there. So what does that all mean? Well, we can talk about the consumer confidence here. So right now, and probably for the next couple of weeks, our consumer confidence levels are definitely going to be dropping. And which is probably what prompted the Bank of Canada on Friday to further slash the lending rate another 50 basis points down to 0.75. So I've had a couple people ask me, well, can we expect further rate drops? I think the answer is yes, but we probably won't go into a negative scenario there. So what's that mean to the consumer? Well, as of right now, over the last couple of weeks, we have seen that your purchasing power is elevated another 5 or 7%. So on $600,000, you're typically able to take advantage of an additional $30,000 in spending power, or you can save that monies. Just to make a quick look here on a couple of scenarios, 400K, the spread is about a savings of about $100 right now. On 900K, your spread is about a savings about 185. What else is going on? So let's talk about what could cause the rate reductions even further. It's important to note that trying to time rate reductions and anticipate them is kind of almost like trying to figure out the bottom of our real estate cycle. By the time it happens, probably the rate has already been affected. What you need to do is look at the bond yield, and one of the things to pay attention to is the illiquidity aspect. So if we saw on Saturday that Scotia and First National actually raised their rates up, that's due to the illiquidity factor. So you need to be very mindful of that. Looking ahead, we probably can anticipate, though, that the mortgage rates will adjust, but just make sure that it's not a lending game. We can probably assume that, if the bond yield goes down, the economy will go down. So what's that basically mean in the North American picture? Well, the U.S.'s lending rate will most likely drop, and the little brother, being Canada, will also follow suit. So that's pretty much it for a quick Economist edition here. If you have any questions more about the mortgage rates, contact us. We've got a couple of great mortgage reps that we can put you in contact. If you want to know what's going on with your community and how this is impacting, by all means, reach out to us, 403-809-3523. Enjoy the rest of the day. Stay in if you can, and stay warm, and stay safe and healthy. Cheers.